Callable bonds are bonds that are issued by corporations, and they can be called back, which means be bought back from the bondholders by the issuer. The decision whether to buy back those bonds, to call back those bonds, is in the hands of the issuer now. What it means is that those bonds are more risky from the bondholder's point of view. Someone else is taking control, at least some control over your bonds. They, the issuers, can call back, buy back the bonds at a predetermined price from you, which means that they will do that whenever they want, whenever they can save money, not whenever you can make money. What it means is that those bonds are more risky from the bondholder's point of view, from debt holders, creditors' point of view, and therefore usually callable bonds will also carry higher yield, higher return, simply because of the higher risk that is involved. You need to understand that callable bonds, once the issuer will call it back, will buy it back from you, they will pay you a certain amount of money, cash, that's it. If you're so much interested in stocks, take the cash and buy the stocks, but you're not receiving stocks as a return. It's not like a convertible bond. So callable bonds are issued by corporations that would like the alternative to buy back the bonds from you. Let's understand under what circumstances companies will issue callable bonds. Imagine yourself the following situation. You're a CFO of a company, and one day the CEO comes to you and tells you, look, we need money, we need to expand, we want to buy more machines, we want to open a new business line, we want to hire more people, whatever it is, we need the money to operate, to expand. I would like to issue bonds. Under what circumstances you will recommend the CEO to issue callable bonds? The answer is clearly you will issue callable bonds only when you expect prices of those bonds to go up. Otherwise, there is no chance in the world that you will buy it back. Remember that callable bonds are issued with the option for the bond issuer to buy back those bonds, to call back those bonds at a predetermined price. Now, you will only buy it back at a predetermined price only if the actual price of the bond will exceed this price. You will be able to buy it at a low price while the actual price is higher. This is how you can save money to the issuer. So from the issuer point of view, the company that is issuing callable bonds, you're going to issue callable bonds only if you think that there is a chance in the future that the price of this bond will go up. We already saw the relationship between inflation to the interest rate to the yield to the price. And the price may go up only when you think that the yield will come down, when the interest rate will come down, and the inflation will come down. So only when you think that the interest rate, the Federal Reserve will bring down the interest rate further, then it makes sense to issue callable bond. Today, for example, 2016, right now the interest rate is very, very low. Anywhere between 25 to 50 basis points, which is virtually nothing. There are very slim chances that the interest rate will bring the interest rate down anymore. In fact, the more we step away from the crisis of 2008, 2009, the chances are that the interest rate will start to go up from this point. So today it really doesn't make any sense to issue callable bonds simply because interest rate may only go up. If it will go up, yield will go up, price of those bonds will come down. If prices will come down, there is no chance in the world that you will buy it back. So what's the point of issuing callable bonds in the first place? Because remember, from the issuer point of view, you need to compensate your investors for the higher risk because it is a callable bond and you are the issuer, you make the decision whether to call back the bond. So if there is no chance that the price will go up, what's the point of issuing callable bonds? You're not going to pay, you're not going to buy it at a lower amount later on. Puttable bonds are the exact opposite of callable bonds. Now, the decision whether to sell back the bonds to the bond issuer is in the hands of the bondholder, the debt holder, the creditor. You can actually buy puttable bonds and force the bond issuer to buy it back from you. In other words, you're selling it to the bond issuer at a predetermined price. Similar to callable bonds, those bonds will just credit you with a cash, with amount of money, not with stocks like in convertible bonds. If you are so much interested in the stocks, go ahead, take the money and buy the stocks on the free market. Now the decisions whether to sell the bonds back to the issuer is in the hands of the bondholder, and therefore usually they carry less risk, less return, lower yield compared to other regular bonds. Sinking funds. Some municipal or corporate bonds are issued with a sinking fund provision, which could be optional or mandatory. In the case of a sinking fund, the issuer pays off the principal of the bond over time instead of at maturity. So what happens with sinking funds is, instead of paying a large amount of money as a par value at the end, the par value is simply added to the coupons and simply spread out during the lifetime of the bond. So it's like getting larger chunks of money during the lifetime of the bond every year or so, instead of receiving some coupons and then a big chunk of money at the end as a par value. Balloon bonds. Balloon bonds is the exact opposite of a sinking fund. You accumulate all the coupons during the lifetime of the bond and you add them into the par value at the end. But in fact, balloon bonds, if you'll think about it, it's the exact same thing as a zero coupon bond. Because if you don't pay any coupons on the way and then you receive only a big chunk of money at the end, it could be just the par value or the par value plus all the accumulated coupon, it really doesn't matter. All it means is just a bigger par value, which is in fact a zero coupon bond. Bonds ladderings. I will leave you to read those slides by yourselves, but I will just describe what bond laddering is. Bond laddering is a technique that many bondholders are doing. They keep a ladder in front of them. They keep pushing this ladder of bonds ahead of them in order to diversify their portfolio. You need to understand that short-term bonds are safer than long-term bonds. First of all, why is that? Short-term bonds are safer simply because the issuer has less chances to default. Less bad things can happen within a short time period. However, if you buy a bond from an issuer and this bond will mature in 10 years or 20 years, more bad things can happen to the issuer over the course of longer time periods. As a result, short-term bonds are safer than long-term bonds, and therefore, usually short-term bonds will carry lower yield, lower return than long-term bonds. Just remember the concept of high risk, high return, low risk, low return. In order to mix together both short-term bonds and long-term bonds, both low yield and high yield, mix them together in a portfolio, what many investors are doing are combining them in a portfolio, and they hold the ladder of bonds that will mature 1 year, 2 years, 3 years, 4 years, 5 years, and so on ahead of them. Whenever the short-term bonds will mature, they will collect the par value, take the money and reinvest them in longer-term bonds and keep on pushing the ladder ahead of them. That's the technique of bond ladderings. Many investors are doing that, and I just wanted you to be aware of that this is a very useful technique to diversify your portfolio, reduce some of the risk that is involved in investing in bonds, and that's bonds laddering. At this point, we would like to move on and discuss some characteristics of bonds. Those are more quantitative aspects of bonds. We will start with the formula of how to price bonds. The very basic concept in finance is that price of any type of investment, the amount of money that you need to pay for any kind of investment, has to be equal to the present value of its future cash flows. This is a concept that we're going to see now, and we will see it more later on in this course. The price of anything, the amount of money that investors are willing to pay for any type of investment, any kind of asset that will give you some return in the future, has to be equal to present value of future cash flows. Why is that? No one is willing to pay more than what you will receive later on in terms of present value terms. Obviously, we have to compare apples to apples. We have to compare money based on the same time frame, on the same point in time. That's the first basic rule of time value of money. So no one will pay more than the present value of future cash flow because this means that you're losing money. However, no one will pay less than that simply because if you will try to pay less than the present value of future cash flows, then other people will bid above you and they will try to take this investment and buy it at a higher price. When more people will buy something, the price naturally will go up until the equilibrium point where the price will match the present value of future cash flows. All right. When we speak about bonds, there are two types of cash flows in the future: coupons and par value. Now, coupons take place every year, every half a year or so, if it is a semi-annual coupon, and par value takes place only once at the end. So the price, P, the price of a bond, must be equal to the present value of all of the cash flows, everything together. What we're doing here, we're discounting to present time all the future coupons, and the way to do that, we're summing, so that's the Greek letter sigma for summation. We're summing all the present values of the coupons. How do we discount the coupons? We divide them by 1 plus the discount rate to the power of t. T is a running counter, it goes from 1 to n. So we're discounting the first coupon by 1 plus the yield to maturity to the power of 1. We're discounting the second coupon by 1 plus the yield to maturity square. We're discounting the third coupon by 1 plus the yield to maturity, which is the discount rate, to the power of 3, and so on and so forth, until the last coupon, which takes place at the day of maturity. Apart from that, we also need to discount the par value. Now, the par value or the face value takes place only once at the end, at the day of maturity. Therefore, apart from this, we also need to discount to present time the par value by dividing it by 1 plus the yield to maturity to the power of n. N here, both here and here, represents the number of years or the number of periods that are left until maturity. This is important to understand, that are still left. In other words, let's say a bond that has 20 more years until maturity. At the beginning, n is equal to 20, and based on that, you can calculate the price. After 1 year has passed, the first coupon is already paid, and then n becomes 19 because there are still 19 more years until maturity. So n goes down as you're getting closer and closer to maturity. Let's see some numerical examples. Let's use this formula to price a bond that is 2 years until maturity. $60 are the coupons, or 6% coupon rate, out of a par value of $1,000. So altogether, at the end, on the day of maturity, you're expecting to receive $1,060, the par value plus the last coupon. The question is, what is the par? So here is the information. N is equal to 2. Coupon rate 6%, par value $1,000, and we're going to examine 3 cases. When the yield to maturity, the discount rate, the return overall is either 5%, 6%, or 7%. Once again, the price is equal to present value of future cash flows. We're discounting to present time all the coupons and the last par value. Let's do that. When the yield to maturity is equal to 5%, the price is, let's discount this to present time, and let's discount both the par value and the last coupon to present time. So when the yield to maturity is 5%, we're taking the $60 first coupon, discounting it to present time, dividing it by 1 plus the discount rate, the 5%. Plus, we'll take also the par value and the last coupon, 1,060, and divide it by 1.05 square, because this is taking place in year number 2. Altogether, if you'll do the math, you will see that the bond price right now, $1,018.59. When the yield to maturity is 6%, you will repeat those calculations, but just replace the yield to maturity or the discount rate at the denominators to 1.06 here and to 1.06 squared here. Same cash flow, 60 and 1,060. In this case, you will receive the $1,000. If the yield to maturity, the return, to investors is 7%, all you need is just to replace the bottom line here, the denominators, to 1.07 here and to 1.07 squared here. In this case, the price of the bond is $981.92. What you can actually see is that the price of the bond is equal to present value of those future cash flows. In addition to that, you also see that whenever the yield to maturity is equal to 6%, exactly the same as the coupon rate, the price of the bond is equal to $1,000, exactly as the par value. This is something that we already saw, if you remember the story about the Brady bonds. Regardless of the number of years until maturity, as long as the yield to maturity is equal to the coupon rate, the price will be equal to the par. The same token, I can say that as long as the coupon rate is below the yield to maturity, the bond will be at premium, which means that the price of the bond is higher than the par value. And as long as the coupon rate is below the yield to maturity, the bond will be a discount. In other words, the bond price will be below the par value. This is a concept that we already saw. We already said that whenever the coupon rate is equal to the yield to maturity, regardless of the number of years until maturity, the price will be equal to the par. Whenever the coupon is higher than the yield, the price is higher than the par. And whenever the coupon rate is below the yield to maturity, the price will be below the par. All three rules are correct regardless of the number of years until maturity, regardless of n. n is equal to 2. Clearly, you can use those calculations to calculate the price, and you can also use a calculator. Let's see how to do that in a calculator. Let's see a quick example with 6% interest rate yield to maturity. So under those circumstances, what you need to do is insert 2 is the number of years. This is n. 6% is the coupon rate. So 6% or $60 are the PMT, the payments. $1,000 is the par value. So 1,000, and then you click on future value or face value or par value. And then 6% interest rate, you click on I/Y. Then you need to ask the calculator, compute present value. What you will receive is the answer of minus $1,000, which is clearly the price of the bond. $1,000 right here. And this is obviously a negative number because the calculator understands that you need to pay this price in order to buy yourself the bond. So whenever you pay, that's a negative cash flow. That's why the price is quoted here as a negative number.